The Bank of England held its benchmark rate at 3.75% on Thursday. The vote was 8-1. Chief economist Hugh Pill stood alone in calling for a quarter-point increase to 4.0%, the sole voice on the Monetary Policy Committee pushing costs higher, while the other 8 held firm. That split matters more than the headline decision. Governor Andrew Bailey framed the hold as an active choice rather than a passive one. He placed most weight on Scenario B from the BOE's Blee Path framework, oil peaking at around $108 per barrel, but staying elevated for longer, with second-round inflation effects playing out gradually. Scenario C, oil at $130 per barrel, requiring what the BOE called forceful tightening, remains on the table. Bailey declined to put numbers on what forceful would mean. Sterling slipped. The pound fell against both the dollar and the yen as traders absorbed a rate statement that offered no closure on the direction of travel. The currency's move told a clearer story than the decision itself. Holding at 3.75% is not the same as ruling out 4.0%. Against that backdrop, UK bank stocks traded in a compressed range. Lloyds ended the session around 84p, up 54% year-to-date, a run that has made it one of the FTSE 100's strongest performers in 2026. Ocado jumped 13.5% after Asda confirmed it would use the company's technology platform for home deliveries, joining M&S and Morrisons. Business confidence data for May showed a monthly climb, though the reading sits against a housing market that the Iran-related energy uncertainty has kept cautious. NatWest and Barclays moved to sweeten fixed-rate mortgage pricing as Iran's ceasefire hopes gave traders room to price a softer rate peak. The session's surface narrative was broadly constructive. Lloyd's sustained rally, Ocado's strategic vindication, improving business confidence, the pieces assembled into a reasonably optimistic picture. The piece that did not fit was the one most Lloyd's holders are not yet pricing explicitly.
Lloyd's at 84p trades at a forward price-to-earnings ratio of roughly 11. Its dividend yield sits just below 4%. A discounted cash flow valuation places fair value approximately 36% above the current price. Every standard retail investor metric points to a stock that is undervalued relative to its earnings power. The unstated premise in that reading is that the earnings power is knowable. It may not be. The Financial Conduct Authority's outline estimate for total industry motor finance redress is £8.2 billion, rising to approximately £11 billion including administration costs. Lloyds has provisioned £1.2 billion. The bank has warned that further provisions may be necessary and could be material. The FCA's consultation on the final industry scheme runs until November. No final figure is set. If Lloyds absorbs between 25% and 30% of an £11 billion industry total, a rough approximation given its historical share of motor finance originations through Blackhorse, the implied liability is £2.75 billion to £3.3 billion. Against £1.2 billion already reserved, the potential shortfall before tax relief runs from £1.5 billion to £2.1 billion. That is not a rounding error against a company whose H1 net interest income is under margin pressure from a rate environment that Thursday's decision confirmed is not yet resolved. The BOE's Scenario B, the one Bailey said he weights most heavily, produces two effects on Lloyds that run in opposite directions. Rates staying restrictive for longer supports net interest margins. The same economic pressure that keeps rates elevated tends to drive loan default rates higher. The two effects partially offset. Which one dominates depends on the rate path and the depth of any slowdown, neither of which Bailey was willing to quantify on Thursday. Here is the position pressure the 54% rally creates. Jefferies carries a 12-month target of £103 on Lloyds, roughly 23% above current levels. That target presumably incorporates a motor finance liability assumption. The question no published target makes explicit is what assumption. If the analyst community is modeling £1.5 billion in total provisions, and the FCA finalizes a scheme requiring £3 billion, the consensus target revises down. The stock is not overpriced relative to current consensus. It may be overpriced relative to the liability that current consensus has not yet fully articulated. Lloyds authorized buybacks of up to £1.75 billion and acquired the remaining 49.9% of Schroders Personal Wealth in the same period that it flagged material additional provisions as possible. Management buying its own shares aggressively while simultaneously warning of unknown future costs is a combination that admits two readings. One is that the board believes the liability is manageable and the DCF discount is genuine. The other is that the timing is coincidental and the buyback reflects prior authorization rather than current conviction. Observers watching the rate of buyback execution between now and November, when the FCA consultation closes, will have cleaner evidence of which reading is correct.
The unresolved question from Thursday is whether the 36% DCF discount on Lloyds is a market inefficiency that will close as the motor finance liability crystallizes at a manageable number, or whether it is the market's rational forward estimate of a liability that will compress earnings and capital ratios when it lands. The Ocado session provides a useful reference point, not because the businesses are similar, but because the mechanism is different. Ocado's 13.5% jump reflected a market that had spent years arguing about what the company was, finally receiving evidence of what it had become, a B2B technology licensor powering M&S, Morrisons, and now Asda. The re-rating was sharp because the ambiguity resolved. 3 signed clients made the business model legible. Lloyd's ambiguity resolves on a different timeline. The FCA consultation closes in November. Final rules will set the total industry bill and, crucially, the methodology for allocating it across lenders. Until that methodology is published, no analyst target incorporates a number that can be verified against a regulatory document. The discount to DCF fair value is real. Whether it is the entry point it appears to be depends on a number that does not exist yet. The continuation scenario for the rally looks like this. The FCA's final scheme lands at the lower end of the $8.2 billion estimate. Lloyd's share of the liability comes in close to current provisions. The Q3 trading update shows net interest income holding above expectations, and the BOE's rate path tracks scenario A rather than B, oil moderating, second-round effects contained. In that path, Jeffrey's 103p target is defensible, and the 36% discount closes partially. The breakdown scenario does not require anything dramatic. It requires the FCA methodology to attribute a higher share to large motor finance originators, Lloyd's under provision to become visible in the Q3 update, and Bailey's scenario B to drift towards C as energy prices stay elevated through the summer. None of those outcomes is extreme. Each is within the range of outcomes the BOE itself acknowledged on Thursday. The checkoff anchor is the number 8.1. One dissenter calling for a hike in a committee of 9 does not move rates, but it marks the point at which the consensus hold began to develop internal pressure, and the market for UK bank stocks is pricing a rate path that assumes that pressure does not build further. If the August meeting produces a second dissenter, the sterling rate complex reprices, and the discount on Lloyds becomes a question about capital adequacy rather than a valuation opportunity. Whether November's FCA ruling or August MPC split arrives first is the sequencing risk the 54% rally has not had to answer yet. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.